Welcome traders to this video where we're going to be looking at some of the intraday trading mistakes that traders often make. So what is intraday trading? Now intraday trading essentially means placing trades within 1 day period. So that essentially means starting your day at the beginning of the day, placing trades throughout the day, and then making sure that they're closed before the end of the day. It's become very popular, especially over recent years on social media platforms where people are advertising, large growth and pretty much unrealistic returns. The fact that a lot of new novice traders coming into the market, they think that they can make quick growth within 1 day period and quickly scale up their account. Often, leads to setbacks and hurdles that they need to get over and re-establish their trading style. It obviously requires a lot of skill for those people that are profitable who are day trading or intraday trading, and it also requires a lot of time because you do need to be behind the PC, you need to be behind the laptop for a relatively long period of time. So that you are actually monitoring the positions. You still need strategy, you still need base methods behind your trades, with correct risk, correct rewards, and basically you need it all calculated still the same way as any other trading plan. It's a much more shorter term, fast paced trading style. So something that I've heard of recently around the trading world is adding trades equals more profit. Well, generally speaking, if you're new to trading, that might seem plausible because obviously adding positions, adding trades is going to increase the amount of leverage on a position, the amount of open sort of volume that you're actually trading, which will allow for more profit. However, that's not necessarily the case for long-term growth. Novice traders may use emotions to trade. Now that might be the case when they start actually trading a position, let's say on the euro versus a dollar. They think it's going to go up, so they start buying it, and perhaps it's moved sideways for some while in a relatively closed sort of zone, and they're entering more positions within that range long, and then perhaps it goes down a little bit further. They continue to add more positions. I'm thinking that the market's going to go up. Obviously, that is trading with your pure emotion and your ability to, obviously win in the market as fast as possible. And that moves on to placing too many trades does cause a lot of mess and havoc on the chart, especially on MetaTrader. I do, obviously always recommend traders use professional charting software and MetaTrader on a PC or a computer, because it offers much more calculated, precise methods rather than using it on your phone. However, we've seen it time and time where traders will place too many positions in a certain spot, and it might even be, let's say, 3 or 4 positions, but that's just 1 or 2 too many positions which needed to be in that trade or in that position or in that sort of trading scenario spot. As I mentioned before, your risk to reward ratio does still need to be very good. I still recommend at least a 1 to 2 risk to reward. Obviously, not all trades are going to reach either your stop loss or you take profit. You may actually close trades a little bit earlier, depending on market scenario, what's happening, news, potentially ideas that you've seen on the chart. But the risk to reward ratio still needs to be positive, because traders still are going to make losses, whether you're trading much short-term scalping or long-term swing trading over months, years, etc. You are still going to lose trades, so you do need to make sure that the risk to reward, you're risking small amounts to make big amounts essentially. And make sure you're doing even with small trades. It doesn't matter if you're, let's say, risking 5 pips to make 10 pips, if you're risking 30 pips to make 60 pips. Always make sure that you're trying to achieve a more reward out of the market, and that's done by looking at where your exit strategy is going to be, where the confluences line up, resistance, support levels, Fibonacci retracement, Fibonacci extension. Look for where the market could come to, where you would want to get out of the market out because it's actually moving in the wrong direction on a, let's say, hourly basis, 2 hourly basis. So make sure that your reward is always set at a correct point where you think the market will actually get to the end destination. Some traders who we've come across as well are only fundamental traders. Now, there are select few that are profitable trading in this manner, because news will affect market prices. They do contribute to the price movements, strength, weakness, overall sort of bias direction. Long term there will be underlying issues and data that sits behind the news that does reflect good decisions within the Forex market. So that's not to say that you shouldn't look at them. I think you should look at fundamentals, but you'd also combine it with other research and data that you can extract out of the market to actually make a more positive trading style. But only using fundamentals, news announcements, just looking at Bloomberg and sources like that isn't good. Obviously for building the amount of confidence is for an actual trading setup and many trading setups. And a lot of people think that if they just find out the interest rate of a certain country or certain currency, and look into the interest rates and the data that sits behind that, then the following day they might actually be able to just understand where the currencies are going to be heading. You can find weakness and strength in the interest rates, and obviously that will affect the Forex market. However, purely basing your whole strategy around just an interest rate and basically flipping a coin whether a certain currency pair is going to go up and down based off the interest rate and the recent data that you may have seen in the prior days isn't really a sufficient strategy. I've used it myself in the past, and I think looking into them from time to time, understanding what's happening in certain economical areas, and looking at the ones that affect the pairs that you trade is a good strategy, and to put into your journal, your archive. But don't just rely on the interest rates. Now, news can also bring unpredictable data. It can be a little bit laggy and it can throw certain movements off. Let's say, for instance, there is, let's say, non-farm payroll. Non-farm payroll comes out first Friday of every month. Perhaps you correctly identify the surge that's going to come from the non-farm payroll. You make the initial trade judgment correct. You go into a small amount of profit, but the luck can actually flick a wick there and then pull it all the way back and then move in the overall direction that it was maybe heading in, otherwise. So it can offer volatility and heavy amounts of movement, because essentially news, it drives money, it drives confidence into the market, so it does make certain instruments move at a relatively fast pace. So understanding that it's there is great. Understanding when it's going to occur, what's happening in general is great, I think. And obviously depending on your trading style, it depends how deep you want to get into the news and fundamentals and how much of the data that you want to study, because this data is coming out every single minute of the day. So there is so much to cut through, which is happening on a very micro level, where it's happening very small ticks. But just what I tend to do is just go for a general direction on a weekly basis, understand what's happening on a news, what's forecasted, what's scheduled, and then add that into my trading plan, and then understand what I can actually take advantage of around that, combining that with technical analysis and other various methods as well. Finally, probably the biggest killer when it comes to intraday trading styles failing is overconfidence and poor management of risk, poor management of the trades, poor management of documenting the journal, all the back end of trading as a trader, really. Obviously overconfidence comes into play when you perhaps win a couple of trades on the row, and potentially you might think your style, your judgments are unstoppable, and that obviously can lead to you applying a little bit more risk on the next trade, and then when one trade does go bad, then it can actually cause pretty devastating effects to trading capital. So keeping a handle on your confidence levels, making sure you're fairly neutral when you do come to the computer, you're relaxed and you're feeling ready to understand the setups, the spots, the certain trading scenarios, and then get involved if you see enough confluences and entry reason to get into the market. They also place unrealistic expectations, which doesn't help. It doesn't help obviously the world of social media and how trading is seen online. This fast quick way to make money on a daily basis, short term quick gains. That's kind of what's promoted online. So it's kind of, you can kind of see when new traders do get into the market and they want to turn a small amount of money into a relatively large amount of money quite quickly on their own in a Forex broker account. Just putting in 100 or 200 pounds, potentially flip that into 4 figures, 5 figures, and a lot of people claim that that's possible online. And I think a lot of these expectations are quite unrealistic. Me myself personally, when I did get into the market, I did actually fall into the trap of actually opening an Excel spreadsheet and basically putting a compound formula in. If you didn't withdraw any profit for 2-3 year period, you can take a small amount of money making, let's say 3 to 5% on a day. You can turn it into several million over a relatively short period of time. Obviously that's unrealistic. It's you need to have a general plan of what you're going to be doing and general targets, but then obviously trading, you can only control the account. Obviously the market isn't controlling your account, you're controlling the account, but then market is where it comes down to the variance and which trades are going to be make profit, which trades are going to be loss, and then what's the after, what basically is the final result. Challenging spots, so there might be trades where it's 50-50 or you feel a little bit uncertain getting into it. A lot of traders might just jump into it for trading's sake because they haven't placed a trade in, let's say, 2 days. They just feel like they need to put on a trade real quick, so they maybe go into a sort of challenging spot without much knowledge or experience in let's say a daily hanging man formation, and they kind of just jump in real quick. Whereas if they was to just wait on a little bit longer and get into a trade where it's more they feel more comfortable with the risk, the confluences, and where the overall trade direction is going to be going, then obviously that might be a better trade for them down the road. And then overall, just lack of proper strategy. Having strategy is obviously the only way that you're going to win in the market. Without one, obviously it's very difficult to make it as a trader. But there are good sources online for you to actually understand different strategies that other traders have used, which ones have worked for traders, and the overall styles that you can be using, whether it's fundamental, technical driven, and then what you're going to be looking at and how much time you're actually going to be putting into the charts to find these trading setups. So yeah, that's really how intraday traders can get caught up in the bad side of trading, obviously the bad habits. But if we can start to eliminate these and try and focus on them, and just even know that they're there in the first place, is a good step in actually progressing as a trader. There's many traders get into the market, and for the first 2-3 years they're just deluded on one pathway and they think that it's going to work, and they keep on repeating the same mistakes. Whereas if we know that they're there and we can understand how to improve them, then obviously that's going to be by keeping an open mind is going to be how you actually improve as a trader. So that's it for this video. Hope you took something away from that, and be sure to stay tuned for more videos to come. Trade safe.